Good morning, everybody, and welcome once again to another Zoom session. Like we've always said, we are committed to being with you every Thursday from 10 in the morning up until 11, at least 1 hour or less, where we discuss some pertinent issues on payroll. Let me welcome you all and thank you very much for affording us your time to be with us. Now, as I begin this particular session, let me just ask one or two people to confirm if you can hear me loud and clear.
Yes, we can hear you.
Thank you very much for that confirmation. Now, today I'm going to be discussing with you, as advertised, we'll be looking at our exemptions and credits on payroll. And I'm going to be talking about these in the context of the new terms regulations. I was privileged to speak at a conference last week at ZITA at Pamuzinda, and I'm going to be using that presentation that I did for us all so that we can also benefit from those discussions that I had. So we're going to be discussing these ones together. Sorry for that interruption. And let me just put my phone on silent. All right. So we're going to be discussing those issues this morning, but in the context of our credits and as well as our exemptions. Now, when you talk of exemptions and credits, these are part of the tax computation that needs to take place on when you're calculating the income tax for an employee. You're going to find that we have exemptions, which we're going to discuss, and we also have credits that were introduced that we also want to look at. Now, the main objectives of this particular presentation that I have for us, number one, is to have an analysis of the FDS requirements for FDS employees and non-FDS employees. I think this is important just for us to continue disseminating that information. And number two, looking at the terms, regulations, and its impact on payroll processing. And so what are we as administrators expected to do with these new regulations that have come through? Number three, look at the non-FDS module in terms and its impact on payroll and what it now requires us to do as well. And number four, expectations for employers, FDS, and non-FDS employees under these new regulations. So I'm just going to be looking at those, touching on those, because I think it's important that we discuss and share, as well as continue to reiterate these issues that are pertinent currently. Now, if you look at, I'm just going to give you a brief background as to, let me just quickly do a brief background on the journey that we've had with our taxation and tax laws. So first of all, FDS system, which stands for Final Deduction System, was introduced in 1999 and was fully implemented in 2000. And this was a new way of computing PAYE on employee income, such that the tax calculated by December is equal to that which ZIMRA would have also calculated. So you'll find that there was an introduction of this new system that was brought in 1999. And this was a new way versus the old way which we had, which was our PAYE calculation. Now, if you remember the PAYE calculation, we used to use yellow books, if you remember very well. And the tax to be deducted from an employee was actually put according to how much the employee was earning. So from the tax-free threshold going forward, there were tax bands, or in fact, tax amounts, not even bands, just tax amounts. So if you're earning 2,000 Zimbabwe dollars at that time, the tax will be so much, $2005, it will be so much, $2010, it will be so much, going right up. So these books were quite huge, and then we would just check to see how much an employee is earning and the requisite tax that was supposed to be deducted. But when the FDS system was then introduced in 1999, you'll find that it brought in a new concept, And there were some major observations that I would like us to take note of so that we understand where we've come from and where we are today. So these major observations, number one, there were allowable deductions which were also taken into account under FDS, which included your NASA, your pension deductions. It also included your professional subscriptions, as well as your tools replacements and donations to charity. This is the crux of what I wanted to discuss with you, but I'm actually going to discuss with you this in context with the new regulations. Now, if you look at the allowable deductions that were brought in, you'll find that these allowable deductions were deducted from an employee's gross tax. In fact, we deduct them from an employee's gross tax. So when you're calculating your tax, the first port of call is to come up with an employee's gross income. Once you have calculated an employee's gross income, you can then deduct these allowable deductions. So these allowable deductions include your NASA and pension deductions. So if you have an employee subscribing to NASA as well as to a private pension, and here when you look at your pensions, we're looking at the pensions to Old Mutual. Maybe as a company, you have a pension scheme that you have crafted together with Old Mutual, and all employees are supposed to subscribe to that. Or you have an industrial pension scheme where, as in a particular industry, you are supposed to be part of that pension scheme, such as your mining industry pension fund, construction industry pension fund. These are industry-related pension schemes. And so if an employee is also contributing to those, they are also allowable deductions. And further to that, you can also talk of your RAF, your RAF schemes, which is a retirement annuity fund. Now, these are personal schemes where an employee on their own, without going through the company, can go directly to Old Mutual or any of these other pension companies, and they can open up a policy for themselves. And they can also have those deductions being made on a monthly basis. Now, that kind of a pension, again, it is also an allowable deduction. So an employee, if they have their own personal pension scheme, they can bring the receipts to the payroll office, and they can also get the same treatment as one who is on an industrial pension scheme or on a company pension scheme. All right. You may have employees who are also subscribing to these. Please ensure that you conscientize them that they should bring their receipts to the office. When you look at your professional subscriptions, these include your NEC, contributions by the employee, trade union contributions by the employee, as well as membership fees to professional bodies such as IPMZ, such as CIMA, such as ACA, CIS, where an employee is paying an annual membership fee. That annual membership fee that they pay, they can bring that receipt to the payroll office, and it is also an allowable deduction. However, please take note that for membership fees, they should be for members and not students, because there's a student membership and then there is a membership fee for one who is fully qualified. So for this one, it's only reserved for fully qualified employees in that particular profession. Okay. The student fees are not allowed. They are disallowed in this regard. Okay. And then again, on our tools replacements, if an employee's contract of employment requires that they also furnish or use their own tools for the work that they are doing, then the amount that they spend in buying or procuring those tools, they can actually bring that receipt to the payroll office, and it is also treated as an allowable deduction. And it's not just buying tools. It's just also even replacing some tools. You know, some contracts say we'll give you a toolbox, which is issued by the employer. You can see this in the motoring industry, where you have mechanics working in these garages and so forth. They are given a fully equipped toolbox. But then the toolbox, there's a clause that then says if you break or if you lose any tool, you are supposed to replace it yourself. So if they replace those tools, the amount they use to replace them is also an allowable deduction. They can bring that to the payroll office and they can also claim, and it can reduce their taxable income. So, the next one is your donations, where you donate. Here you can make donations to several places. You can donate to charitable organizations. Here we're looking at trust funds that are looking at charity. For instance, your Gyros GD. You can also look at SOS Children's Home and any other charities that are registered with the Ministry of Labor and Ministry of Social Welfare, sorry. You can also donate to those. The amount that an employee donates to charity can also be an allowable deduction. And you can also donate to government initiatives. Now, when you're donating to government initiatives, we are looking at things such as clinics, maybe in your home area, in the rural area, and government is having an initiative of building a clinic, and they may ask for donations to come through. You may buy cement, you may buy roofing tiles, you may buy any equipment that you may buy. You may even buy drugs, you may even buy equipment to be used within the clinic, within the hospital that you are actually working with. You may buy blankets that patients can actually use. Any donations that you make to a government initiative, a government institution, they also give you a receipt. That is an allowable deduction as well. And you can also donate to mission hospitals. If you are to donate to those, again, it's an allowable deduction as well under donations. Now, the net effect of allowable deductions is that they reduce your taxable income. So when you're calculating tax, the net effect is that they are actually going to reduce the tax that you're going to remit to our tax authority, which is ZIMRA. Now, you also have what we call exemptions. They are not on my slide. I hadn't spoken about them in my presentation, but I think it's important that we also discuss these ones. They are exemptions. Now, the difference between allowable deductions and exemptions is that allowable deductions, they are deductions that you are going to make on an employee anyway, such as your NASA pensions and your NEC, etc. But with exemptions now, these are earnings that you're paying an employee. And these earnings are not subject to tax. In other words, they don't attract tax when you give them to the employee. Now, for our exemptions, we have three main ones in the private sector. Number one, the first $700 of a bonus is an exempt item. So what that means is if your employee is given a bonus, the first $700 is tax-free. If an employee's bonus is below $700 that they've been awarded, it means the whole bonus is tax-free. If the bonus is above $700, it means whatever the bonus amount is, we first of all subtract $700 and then the remainder becomes taxable. So an exempt item is the first $700 of a bonus, number one. Number two, you also have the travel and subsistence allowance that can be given to an employee. So your travel and subsistence, where you are given money to travel for business, where you are given money for accommodation whilst you are doing that business in that area, that amount is not considered an earning, but it is a business expense. Therefore, it does not attract any tax. Okay, so if you are paying your employees T&Ss through the payroll, they should not be taxed. I know in government, they now have a new policy, especially in some government departments, where they say, if you're going for work, you go using your own money, you do what you do, and then when you come back, you claim. There are also companies that do the same, where an employee will use their own personal money, and when they come back, they are refunded or reimbursed by the organization. And that reimbursement is done through payroll. So when it is done through payroll, we need to ensure that the T&S is not taxable because it is considered a business expense. Number three, we also have what we call entertainment allowance for business, where an employee is given an entertainment allowance to solicit for more business for the organization. A good example, maybe there's a golf day that is taking place, and an employee is given money to go and register to participate in that golf tournament. That money the employee has not earned. So even if you are putting it through payroll or you are giving it to the employee, it is a business expense. It is not an earning, therefore it does not attract tax. So you also have these entertainment allowances for business, but please take note, this amount is being given to the employee for business purposes. Some employees are given entertainment allowances because of their positions in the organization. For instance, they are the general manager and they have a fridge and they have drinks that are put into that fridge for them to entertain visitors that come in for clout, etc. You will find that when that happens, that entertainment allowance is because it is position based. It's not to look for more business, but it is to recognize a particular position in an organization that attracts tax. Okay. All right. So that's on our exemptions and also our allowable deductions. So now with these allowable deductions, what then happened? Coming back to our presentation, what then happened is when FDS was introduced, the employer was then allowed to process these allowable deductions on payroll. That means that you could now accept these receipts from employees and put them through and process the payroll. Not only that, when FDS was introduced, it also brought in a number of credits that we were now supposed to take into account when processing pay. And these credits included our elderly persons, blind persons, disabled, and the medical credit. Now, with the elderly persons, this is for somebody who is 55 years or more from the beginning of a fiscal year, meaning that in January they must be 55. Now, if they turn 55 during the year, they have to wait until the following fiscal year in order for them to enjoy that elderly credit. And the credit currently is sitting at $75 per month or $900 per year. Now, the effect of a credit is that it directly reduces the tax an employee was supposed to pay. So when you calculate an employee's gross income, when you deduct exemptions from that gross income, when you deduct your allowable deductions, you remain with the taxable portion or taxable income of that employee. You then calculate the tax based on that taxable income. Once you get that tax, you can then bring in the credits. So you are then saying once you calculate an employee's tax, if they have an elderly person's credit, as an example, you then deduct $75 from that particular tax that would have been calculated, meaning that the employee's net is going to increase by $75. Why? Because we've reduced the tax liability by $75. So you'll find that credits directly affect the tax that is going to be remitted by an employee. So there's the elderly person's credit. There is the blind person's credit. This is for a blind employee. There's the disabled person's credit. This is for a disabled employee. And the disability credit is also extended to spouse and children. So if an employee has a disabled spouse or a disabled child, they can also enjoy that $75 for that spouse or child. Okay, meaning that even if they have more than one disabled person in the family, you can actually then claim for the number of disabled persons in the family. So if you have 2 or 3, it means now you have $75 times 3, and then you can now go and get that $225 as a credit towards your tax. So you're saying whatever tax the employee was supposed to pay, less the credit, the remainder becomes the tax the employee pays. If the employee's tax liability, or in other words, the tax they're supposed to pay, is less than the credits that are due to the employee, it means the employee will not remit any tax to the taxman because the credits surpass the tax liability they are supposed to pay. So you have the elderly, blind, disabled, as well as the medical credit. Now with the medical credit, it says it's $1 for every $2 that an employee has spent on any medical expenses for themselves, spouse, and children. Now, this is loosely translated as 50%. But when you now look at it, it's actually not 50%, but it's $1 for every two. That means if an employee has paid $13 towards an expense, they are not going to get $7.50. Oh, sorry, they're not going to get $6.50 as the credit. They're only going to get $6. So it's only considering the dollar per $2 and not the exact 50%. Please take note of that. That has been raised as an issue by ZIMRA. So when you now have these credits, these were introduced to us in 1999 into 2000, and it became part of the tax computations that we were allowed to do. And you realize that the payroll logic that was then put into our systems and softwares also took that into account, whereby every employee who then was elderly or blind, disabled, or had a credit, a medical credit, it was processed through pay, regardless of whether they were FDS employees or they are non-FDS employees. And you may be asking, Nick, what are these? So when you talk of your FDS employees, we're saying these are employees. This concept was also introduced at the same time with the FDS system. So FDS employees, these are employees who are with the organization for a complete 12 months. And non-FDS employees are those that join during the year. In other words, they don't have a complete 12 months. Now, when this logic was introduced in 1999, when credits were being given, you realize that they were given regardless of whether an employee was FDS or non-FDS. Right. Now, when this system was introduced in 1999, there were certain expectations that were then also brought in together with it. Now, the expectations included, number one, employees were no longer issued with P6 forms because the employer, number two, was required to submit an ITF-16 at the end of the fiscal year, which would then be used for tax assessments. So employees were no longer issued with P6s, and they stopped in 2000. Number three, the ITF-16 would only record FDS employees, and an assessment was done for them, and a variance report was produced. If you remember very well, we would then submit our ITF-16 electronically to email addresses supplied or given to us by ZIMRA, and then would send those, and then they would do an assessment of that ITF-16. And if their tax varied from the tax that we had computed for the whole year, they would produce a variance report. And if the variance was large, they would then inquire as to why we have variances with them. And this was done at the end of the year, and would get this report after submitting our ITF-16 by the 30th of January of every fiscal year. Now, in 2024, the terms was introduced. And they introduced the employee management module, which was launched. I know that they'd started other portals earlier than that, but for us, that affected us, the employee management module was launched, and it brought in some requirements, which I think are important that we realize in our journey together. The employers were required to submit a monthly ITF-16 for FDS employees. Do you see now the difference? With the first initial system that we had from 1999 up to 2024, we only submitted the ITF 16 at the end of a fiscal year. In fact, at the end of the year, we were supposed to submit it by the 30th of January of the following year. But now, with the launch of the employee management module, we now had to submit an ITF 16 for FDS employees. And the annual ITF 16 was requested for year ending 2024, but as you remember, it wasn't requested for in 2025. So the last year that we had submitted an ITF 16 was year ending 2024. Now, P6s, again, were not required at the initial launch of the employee management module, and employees were supposed to be registered and receive a TIN number, a tax identification number. And that exercise started then. And it continued to current. Right, now moving on, again, we had the introduction of the non-FDS module, and this was introduced in November 2025. If you remember very well, this came in and 2 upload files were now supposed to be generated. In other words, 2 ITF 16s, which we're doing on a monthly basis, were supposed to be generated. One for FDS and the other for non-FDS employees. So if you look closely before I proceed, not much was done for non-FDS employees, even from the inception of FDS in 1999. You realize that the ITF 16 that we're submitting on a yearly basis was doing an assessment only for FDS employees. But non-FDS employees, not much was being done. Up until 2025 in November, when this non-FDS module was also launched. And because of that, non-FDS employees were no longer allowed, under this new system now, allowed to access credits during the year until they submit an ITF-1 at the end of the year of assessment. So you realize that last year that this brought a bit of a problem. Why? Because you're going to realize that in 2025, our payroll logic, remember, from a historical point, was giving credits regardless of whether the employee was FDS or non-FDS. But when they now launched the non-FDS module in November, it meant that we were supposed to recalculate our taxes for non-FDS employees from February right up to December. Why? Because now we had to take out the credits, because they were saying these credits are no longer applicable for non-FDS employees. Yet our payroll was actually taking those into consideration because this requirement was not there until November. So you realize that last year, we then had variances from the terms calculation that was being done versus the calculation that was done by payroll. And therefore, a resubmission of the ITF 16 was supposed to be done last year so that we would be able to have the correct information for our non-FDS employees on payroll. Now, the credits included the elderly, blind, disabled, as well as the medical credits. These were then withdrawn, and they are still withdrawn even up to today. This is the communication that we are trying to have, with our tax authority. I know our boss, Simon Pitt, has written to ZIMRA, asking them to reverse this particular requirement, because what it means is when an employee moves from one employer to another, they lose these credits. So, for instance, if you had the elderly person's credit because you are 55 years or more, and you decide to change jobs from one company to another, once you join the new company, you can no longer access that elderly credit until the end of the year. Honestly, to us, this is a bit of a surprise. And in fact, the logic isn't very clear why they decided to do so. Yet an employee is still 55 years or more and should enjoy that credit, even though they have moved from one company to another. When we looked at this particular withdrawal of credits, one of the discussions we had at the conference, and I think this is a point that ZIMRA should take, is that behind the scenes, ZIMRA has all our information, our income information on the TAMS platform. Why? Because if I am with a particular company, I'm registered, I get a TIN number, that TIN number, I'm supposed to use it for life. So if I move from one company to another, let's say I move in June, TAMS has already my income information and everything, my tax that has been deducted from January up until June. So when I now join another company, even though I'm under that company, I'm still going to use the same TIN number, meaning that behind the scenes, though my new employer does not know or is not privy to what I was earning in the old company, TAMS has that information. So still, we should really see that with TAMS, there is no non-FDS employee because TAMS is all our information. And therefore, on that premise, they should not withdraw the elderly or the blind or the disabled and even the medical credit because they already have our information. But maybe we've asked them to really look at this and allow us to continue with the credits, but they have not allowed us to do so. So far, they've withdrawn the credits from all non-FDS employees. Right. Now, just as you know, a public notice was then issued on the 20th in fact, the first one was issued, public notice number 20, sorry, which was issued at the end of April. I think it came into effect, I think on the 2nd or 3rd of April, somewhere there. And it was calling up item number 6 for the submission of income tax returns by non-FDS employees. And it gave us a list of who the non-FDS employees are. And they are saying these are employees who've worked less than 12 months or have changed employers or have received income from more than one employer or receive pensions in addition to employment income. So these employees are supposed to have submitted the ITF-1 by the 30th of April, 2026. Now, in their initial communication with us, they had said that the ITF-1, which is supposed to be filled out by an employee who is a non-FDS employee, was supposed to be done electronically. But as we know that when we checked on their portal, the ITF-1 form was not available electronically. And some companies decided to inquire and they were told they could download the hard copy, or which is an ITF-1, and give that to non-FDS employees so that they could fill it out. So they did that. And we also then realized that the commissioner then extended the deadline from the 30th of April right up to the 30th of May. So we are still within the period. I'm not sure. I will check. I wanted to get a hold of ZIMRA and ask them if it is now available. If you have been on the portal and you've seen the ITF-1, you can also share with us just now as I conclude. And so you'll find that now we are supposed to send in those hard copies. If you have done so, you can also share your experience. And we're supposed to do that by the 30th of May. So they've extended the deadline, obviously to give themselves time also to get their act together in regards to having the electronic ITF-1. So every non-FDS employee is supposed to fill out an ITF-1 now. And this is, or in actual fact, it contains the employees' information, remuneration, before they joined the current company. So whatever they received from other employers during the year, they're supposed to reconcile that and fill that in. So What does a non-FDS employee do? Let's have a look at that very quickly. Number one, they must compile P6 forms from all employers they received income from in the year 2025. What does that mean now? It means that the P6 that were abandoned when FDS was introduced in 2000 has come back. An employer must now issue an employee with a P6 form when an employee resigns and is leaving your company. So instead of just processing the employee's terminal benefits, you must also give the employee a P6. So if an employee changes employers maybe 2 or 3 times in the year, they are now supposed to compile those P6 forms and add them together to get the total income they received, total pensions deducted, total allowable deductions and everything. And they're supposed to put that onto the ITF-1, which they're supposed to submit. And they should also request for their TIN number from the payroll office, because on the ITF-1, they are supposed to fill out they put in their tax identification number. Now, this process of filling out the ITF-1, let me be very clear. This must be done by the employee themselves. The onus is not on the employer to do it. Why? Because the employer, the current employer, is not privy to an employee's earnings, even from the previous employers that they had. So you're supposed to simply give them the form and they go out and they fill out that form on their own. And they can actually visit the nearest ZIMRA office or ZIMRA kiosk where they can be assisted with this process. So an employee can walk into ZIMRA today and say, can you please assist me to fill out my ITF-1? And they should be able to get assistance to do that. Now, before I look at the payday update, I just want us, whilst we're thinking about that, I want us to look at the administrative challenges with these new requirements that have come through. Challenge number one that we get: record keeping must be accurate for each employee. Now, what that means is employees must keep their medical receipts until April of the following year in order for them to claim. They should know the total medical expenses that they've had during the year. That means they need to have some good, accurate record keeping. Now, I know we normally don't even keep pay slips. Some employees don't even have their pay slips. They just look at their pay slip and then they even throw it away sometimes, which is a waste of paper. And sometimes they don't have very good record keeping of this. So you need to encourage your employees to keep their receipts and to keep a total of their expenses so that they are able to claim those at the end of the year. Number 3, competence levels to fill out the ITF-1 need to be high. And this can be a challenge for low-skilled employees. What I'm basically saying here is you'll find that even when I was looking at the form and as I was assisting one person to fill it out, I had to stop and think. And I've been doing payrolls for many years. Now imagine an employee who doesn't even understand all these things. A farm worker who has never looked at an ITF-1, and they are supposed to be sitting on their own, recalculating these things and being able to put that onto an ITF-1 properly and being able to go on their own to submit the ITF-1. You'll find that I think at times ZIMRA is expecting too much from us. And you're going to realize that as HR practitioners, as payroll administrators, you may actually have to give an extra effort to help employees to fill out those forms. Number 4, if done electronically, there is need for digital gadgets, smart devices, and computers for the upload process to be done. And so you find that a lot of our huge chunk of our population, yes, they may have phones, but they may not have a gadget that is able to work in regards with the ITF-1 to go onto the portal, the TAMS portal. So TAMS needs to look, ZIMRA needs to look at how best they can also help the population, especially those that cannot access the ITF-1. what I see is a lot of the ITF ones are going to fall back onto the laps of payroll operators so that they actually do it themselves in order for that to be done. And these are some of the administrative challenges that we have. And I'm discussing these with you. I'm highlighting these so that you can also think and prepare. You already know the non-FDS employees that you have in your organization. You can also prepare. You can actually help them before the deadline comes up, which is going to be in a week's time. Next week, the deadline will be up, and we are supposed to have submitted all the ITF ones. So please think about this, how best you can actually help your employees. You should conscientize them. You should download the forms and give the employees those forms. Now, with these new requirements that have come in, us as your payroll provider, we have the PayDay update that we did. And that PayDay needs to be updated so that your PayDay needs to be updated so that it is compliant with the new regulation. So if you find that in your payroll right now, you have non-FDS employees, in other words, employees that joined your organization after January, those employees must not get the credits. They must not get the elderly, disabled, blind, or the medical credit. But you need to be very careful because you may have employees that have joined your organization after January, maybe in February, March, and you're actually deducting medical aid from them. If you have not updated PayDay, it means that the tax calculation that is being done on your payroll is taking into account those credits as the old logic that we had. You are supposed to get an update from Touchstone so that it will withhold credits for non-FDS employees. In other words, it will stop granting, those are the terms I was asked to use, to stop granting employees the medical aid credit. Otherwise, you're going to grant them. When you now want to upload onto terms is not granting the credit. So what will then happen? You will have a variance on your tax. So please ensure that you get this update from us. And number two, the update will also help just to make sure that your regular and irregular earnings appear in the correct columns on the terms upload. And then number three, PayDay can generate accurate P6 forms for non-FDS employees. So you need to get this update from us so that you update your payroll system. I know with our P6 forms, they've always been accurate, they've always been good, but just make sure you get our update so that it withholds the credits from non-FDS employees. And also ensure that when you get the update from us, also ensure for your basic pay code, this is how it should be set up. Please ensure that, just draw your attention to where it says include in calculation, NASA yes or no, make sure there's a tick. In WCIF, yes or no, there is also a tick in that particular area. So as I conclude, as I come to an end of my discussion, and I'm going to be opening up for questions, the key takeaway points that we need to have: number one, employers now need to issue P6 forms to non-FDS employees. And this is a non-FDS employee, one who is resigning, leaving your organization, or one who joined during the year. You need to also give them a P6 form. If you are an employee, this is one that we don't talk about a lot, but if you are an employee with multiple incomes, in other words, you have more than one employer paying you in a pay cycle, you also need to get a P6 from each of the employers at the end of the year so that you can reconcile those P6s to come up with your totals, which you are now supposed to then declare to ZIMRA. Number two, employers must withhold credits on payroll for non-FDS employees. If this is not observed, it may cause variances. Please ensure that you get the update. And then number three, a non-FDS employees must fill out an ITF-1 at the end of the fiscal year and must submit it as soon as it is called for by the Commissioner of Taxes. So ensure that when you're now, for your non-FDS employees, ensure that they actually get the ITF1 and they fill it out. Now, if your employee has already left your organization, the only obligation that you have is to give them their P6 when they leave. So if somebody is leaving today, you give them the P6 form. At the end of 2026, they should gather their own P6 forms, fill them out themselves, and then submit to ZIMRA. The onus is not on us. If somebody joined your organization during the year, you're supposed to give them a P6 form. If they're still with you, you can download the ITF1 since you are the center of information, and you can give them that particular ITF1 so that they fill it out themselves, and they must take it themselves to ZIMRA so that they can claim the credits that were withheld during the fiscal year. So please, I think this is very, very important for you to be able to do so. All right, so this is what I wanted to discuss with you. I was discussing exemptions and credits, but at the same time, I think it was important that we also remind each other of the current requirements that we have and the update that we are supposed to take. I'm now going to open up this particular time to us. If you have any questions, any comments, any experiences that you've had which you would like to share with us, I would like to open up this time to us all. You can unmute yourself and you can go ahead with your comment or question.
Hello, Senik.
Yes.
Thank you very much for taking us through. I just wanted to know, maybe I could have missed it out. I just wanted to know if group life cover qualifies as an allowable deduction. I had sent it on the chat.
Oh, the chat. Okay. Yes, I'm now seeing your chat right now. Group life cover, life insurance is not covered. Life insurance, that's an insurance. It's not a pension. It's an insurance. That's a different thing altogether. So you find that with your life cover, if you're contributing, you're paying towards a life cover, that is for when, for instance, if you become deceased and your family is going to be receiving an insurance cover, is going to be receiving a payout. That is slightly different from pensions. When you talk of your pension, this is your retirement fund for you to enjoy when you retire. So you find that in terms of our tax laws, pensions are covered, but life covers, insurance, it is not covered.
Okay, it's fine. Thank you very much. Thank you.
You're most welcome, Brighton. Are there any other questions?
Hello, Nikki.
Yes.
This is Singwaza from Pokwe Town Council.
Good morning, Mr. Singwaza.
I want to ask you on exit package credits. If an employee exit package credit, yes. If any employee retire at the age of 65 years, considering the tax credit of 900 per annum, in the case of exit package that is calculated using 2 months salary for every year worked, is the 900 tax credit per annum just given for the period when the employee turned 55 years up to 65 only, or is the credit for every year worked? Is it the credit given for every year worked, or for the portion, that's just for the portion from the 55 to 65 years?
Okay. All right. No, thanks, Mr. Singwaza. When you're talking of, let me bring you back into context. If an employee is retiring, in other words, they've reached 65 years, and let's say they're retiring in November. Yes. Already, they are receiving their credit on the current earnings that they have been earning before they retire. So
Okay.
in terms of tax computations, there is no lump sum credit to be given for future earnings that are going to be given to an employee, but we only consider what the employee has earned in the current month, and we apply the current amount, which is $75. And the maximum which is given per year is your 900 if the employee has worked for the full year. So the credit is awarded up to the point of termination of the contract of employment for that particular employee. Okay, this is how it actually works. If you look on PayDay, you'll even see on the payslip at the bottom, if an employee has an elderly credit, it actually accrues on a month-to-month basis. So when an employee then retires at the particular month of retirement, the credit also ceases, and that is finished off. What can then happen is if you pay out the employee all their items, you can give them a P6 form. If they come back as a locum or they go and work elsewhere as a locum employee, in other words, they have a contract that is coming after retirement, they can work there, get a P6, and then they can combine the two, give them to ZIMRA under an ITF1, and an assessment is then done. And if ZIMRA so feels they wish to then direct the taxes and include a credit of some sort, they can then do that. But the procedure that we have as payroll is we give the monthly credit up to the point of retirement. This is how it works. I hope I've answered you, Mr. Singwaza.
Okay.
All right.
It's okay.
I've got Doreen. Okay. Thanks, Mr. Singwaza. Thank you very much.
It's
I have
okay.
Doreen
You're welcome.
Okay. Doreen also comes in. She says, thank you very much. Kindly help there. Is an employee who submitted medical shortfall claims for the years 2024 and 2025 at the end of April or at the end of April 2026. I have written to ZIMRA for clarity. They have not responded to date. Any advice you can give? I have checked the ZIMRA website. It does not provide guidance on how we should deal with such claims for past years. Thank you. All right. According to FDS, thanks, Doreen, for asking that question. If I heard you right, from your question there, we're looking at medical claims for past years. Now, the Finance Act says that we can only process credits for the current year. If you have credits that accrued to an employee in a previous tax year, maybe 2024 in this regard, we cannot bring them in when you are now looking at the taxes for 2025. Neither can we bring in claims that were unclaimed in 2025. We cannot bring them into 2026. What that means is, for your non-FDS employees, let me bring it back to our context. For your non-FDS employees, they must only claim expenses that they incurred during 2025 when they are submitting their ITF1 for year ending 2025. For non-FDS employees for 2026, if they incur any medical expenses, they must keep them and they must claim them when they are now submitting their ITF16 for 2026, which they're going to actually do in 2027. So you can only claim, just to summarize, you can only claim for the current year. For previous years, you cannot claim. This is the guidance that I can give to you, Doreen. Thank you very much for that question. Okay, are there any other questions that we might have? If you have questions, you can unmute yourself and you can ask your question. If you have any experiences that you may want to share, you can also go ahead and do so. Well, it seems that there are no questions. And in my chat, I think it's clear. I have no other chats that are coming through. I want to thank you all for joining me. But before I call this meeting to an end, let me just remind you of our upcoming events that will be coming on. Next month, we have a full throttle of training sessions coming in. We have in the first week, we have our Getting Started course. So if you have anybody in your companies who needs training, who has never used the payroll and you want them to be introduced to PayDay, we need to use that software, or they've been using it for some time, but they don't have certification from us, you can please register those to come in for our Getting Started course that will be happening next week. And for next week, for the next week but one. And the dates, so that you can just diarize those dates. If I look for the Getting Started, it's going to be on Tuesday, the 2nd of June, up to Thursday, the 4th of June. Please diarize those. Then after that, the following week, we have our intermediate course. For those that have done level 1, it's important that you also do level 2, so that you get the full complement of the tools that you can use on PayDay. And the intermediate course is going to be on the 9th up until the 10th of June. And then after that, the following week, we also have our advanced course that will be running from the 16th to the 17th of June. So we've got a full bouquet of courses that are coming up next month. Please book with us, register with us if you want to do the Getting Started, the intermediate, or the advanced. And then lastly, we have our breakfast meetings that are coming on, and they're going to be in July. Let us all come in. Again, we'll be inviting ZIMRA, inviting NASA, and we are also going to be having some human resources topics that we'll be talking about. I believe we're going to be analyzing our collective bargaining agreements, and we may be using some particular industries as our samples and examples there. So you can also join us for our breakfast meetings. Come, let us interact. We'll be coming to Bluewayo, Kwekwe, Harare, and Mutare. So let's diarize those. They're also coming up in July. Let's start preparing for those as well. And with that, ladies and gentlemen, thank you very much for joining us today. Let us meet next week on Thursday, same place, same time. And from us at Touchstone, have a wonderful Africa Day on Monday. Enjoy yourselves and let us celebrate us being Africans here in Zimbabwe. Let's enjoy ourselves as Africans. Otherwise, thank you very much. Let's meet next week on Thursday. Have a good day.
Thank you.
Thanks, Mrs. Samba. Have a great day.
Thank you, Nikki.
Sure, you're most welcome.
Okay.